As I'm recording this, silver isn't some sleepy metal in the $20 anymore. Silver futures are trading around $59 an ounce, up roughly 80% in 2025 alone, after tagging an intraday high just under $60. All of that against a backdrop of economic uncertainty, trade tensions, and rolling geopolitical shocks. And yet, if you open a big bank research note, you see something very different. JPMorgan's official forecast still has silver at around $38 Oz by late 2025, a catch-up trade driven by strong fundamentals after base metals stabilize. Other major houses, Citi, Bank of America, and Friends talk about $40 silver, not about triple-digit blow-offs or silver tsunami scenarios. So why on earth is this video called "The Coming 500% Silver Shock? What JPMorgan's secret moves are really telling you"? Because those bank reports are one language, and bank behavior is another. By the end of this video, you'll understand why the same world that just gave you $59 silver, while big banks were still talking $30, $40, can also produce much larger shocks. What JPMorgan's past metals activity and current role in the vault system quietly reveal about how fragile paper silver really is. What a realistic 500% silver shock would look like, not as a hype line, but as a structural scenario, and how a normal person can position calmly without leverage, memes, or trying to outguess a trading desk. This is not personal financial advice. It's pattern recognition and risk mapping. Let's start with the paradox we're living in right now. 1. We already broke the script, and almost no one noticed. Look at where we stand. Silver is approximately equal to $59, up over 80% in 2025, with days where it screams nearly $1 higher in a single session. Headlines mention deficits, solar demand, trade tensions, and safe haven flows, then move on. Meanwhile, the official house view from a major player like JPMorgan talks about silver catching up to around $38 Oz by late 2025, a level that's not only below today's price, it sounds like a rewind, not a forecast. Other big institutions aren't much different. Citi, Bank of America, and others highlight structural deficits and solar demand, but still anchor their price targets around the $35, $40 zone. So we already have a disconnect. Market reality has pushed silver to $59. Mainstream expectations still cluster in the high 30 seconds, low 40 seconds. That alone should tell you something. Even after an 80% move, the people writing the reports are still trying to drag the story back into a comfortable range. But deep in the plumbing of the silver market, the story isn't about a neat forecast at all. It's about structure. And that's where JPMorgan comes in. 2. What JPMorgan has already told you quietly, we're not going to throw labels or accusations. We're going to stay with public facts and obvious implications. The regulatory chapter. In 2020, US regulators and JPMorgan reached a large settlement related to past trading in precious metals and treasury futures. Authorities described years of trading activity on the metals desk that they said gave a misleading impression of supply and demand, often referred to as spoofing. JPMorgan agreed to a very substantial financial resolution, one of the largest ever tied to futures market conduct. Former traders on that desk later faced individual court cases and received legal outcomes of their own. The point is not to relitigate any of that. The point is, if silver were truly small, trivial, and irrelevant, you would not see a dedicated precious metals desk at a global bank, years of detailed regulatory focus, nearly $1 billion worth of combined financial impact around how that market is handled. That tells you how sensitive the pricing mechanism is and how much it matters. The vault side. On top of that, JPMorgan has long played a major role as a custodian in COMEX-approved vaults. At various points, analysts tracking exchange inventory have highlighted that JPMorgan-branded facilities hold a large share of reported silver stocks. Much of that metal is classified as eligible, owned by clients, often linked to ETFs or long-term holders, not necessarily registered and ready to deliver against new futures demands. That distinction matters. Total inventory might look enormous on a spreadsheet, but the pool of metal that's actually free to move when stress hits is much smaller. So when you put these pieces together, what do you see? a thin, sensitive price mechanism that regulators felt needed cleaning up. A vault system where a big chunk of the metal is theoretically visible but not truly available. A price that's now $59, while the official narratives from big institutions still talk about the $30 seconds and low $40 seconds. That is not the setup for a calm, predictable market. That is the setup for non-linear moves. Which brings us to the 500% part 3. What a 500% silver shock actually means, it's not what you think. Let's be clear up front. JPMorgan is not predicting a 500% move. Their published research talks about $38 by late 2025, not $100, $150 or beyond. Other big houses cluster near $40, not some wild multiple. So when we talk about a 500% silver shock, we are not quoting a bank forecast. We're exploring a scenario based on structure, not headlines. Historically, silver has already shown you what impossible moves look like. In the late 1970 seconds into 1980, silver multiplied several times over in a relatively short period. Other small essential metals, like palladium around 2000, have also delivered multi-100% moves when supply squeezes collided with rigid demand. A 500% shock in this context doesn't mean tomorrow silver goes from $59 to $300 in a single candle. It means the system has been quietly stretched so far that when the next phase of stress arrives, the new equilibrium price for real metal could be several times higher than what today's research notes imagine. Put differently, big banks' public forecasts live in the $38, $40 world. We're asking, what happens if the market stops caring about that world and starts pricing based on who can actually get ounces? That's where physical scarcity and paper structure collide. 4. The two silvers, screen versus scarcity. To understand how a multi-100% repricing can happen in a world where big banks still publish calm forecasts, you have to separate screen silver, futures, ETFs, derivatives, digital balances, scarcity silver, coins and bars that real buyers and real industries can actually touch. Right now, at around $59 silver, the screen side looks orderly. Contracts trade, spreads are tight most days, research notes talk about fundamentals and catch-up trades. The scarcity side is more tense. Years of structural deficits, where total demand, solar electronics investment has exceeded mine plus recycling supply. Surging use in solar panels, EVs, high-tech electronics, and defense applications. Periods where premiums on physical products widen significantly over spot, and popular coins, bars go on backorder. The official forecasts $38, $40 live almost entirely in the screen world. If growth does X, and rates do Y, and base metals do Z, fair value is maybe here. The shock happens when the scarcity side stops playing along. Imagine a few layers stacking. Industrial demand doesn't slow. Solar capacity targets keep rising. Grid upgrades continue. Electronics and defense needs don't vanish because someone cut rates. Investment demand stays elevated. After an 80% move to $59, some profit-taking happens. But more people now wake up to silver's role as a hard asset outside the banking system. Exchange and vault stocks look big, but usable metal is thin. Much of the eligible inventory is effectively locked to long-term holders and ETF structures. The portion truly available for new delivery shrinks. Dealers and big custodians quietly step back. After years of scrutiny, they're more careful about committing balance sheet. They widen spreads and become more selective with large physical deals. Now add a catalyst, a surge in industrial orders, a geopolitical shock that pushes more investors into metals, a new policy move that undermines currency confidence. Suddenly, the key question isn't, is fair value $38 or $40? It's, at what price will actual holders agree to part with real metal? That price may not care what any forecast said 6 months earlier. That's how you get a world where the old comfort zone was $20, $25. Then you unexpectedly visited $59 in less than a year. And in a true supply-demand reckoning, the number that clears the market could be several times higher again, not as a meme, as a settlement between real buyers and real holders of a scarce industrial monetary metal. That's your 500% shock. not an intraday spike, but a new normal that today's consensus can't see yet. 5. What JP Morgan's story actually tells you without saying a word. Let's put the pieces together. Regulatory history. A major precious metals desk spent years trading in ways regulators later said distorted the picture of supply and demand. Large settlements followed. Behavior was adjusted. That tells you the price mechanism is delicate enough to matter. Vault footprint. JP Morgan is and has been a major name in the exchange vault system. A lot of metal sits there as eligible, owned by clients, often tied to ETFs, not necessarily for sale. That tells you the headline stockpile isn't a free-for-all. Public forecasts. Their official line on silver is a fairly reasonable $38 by late 2025, with other banks clustering around $40. Nobody in that circle is publicly predicting a 500% surge. That tells you the comfort narrative is still anchored to moderate, model-friendly numbers. Put together, the hidden message looks like this. This is a small, sensitive market. It sits under real regulatory and reputational scrutiny. It also sits under a huge burden of industrial demand, investor interest, and finite supply. And the structure is tight enough that we talk about moderate prices on paper, while the real system quietly edges closer to its limits. JP Morgan's secret moves aren't about a magic trade. They're about a pattern of behavior that shows you silver is important enough to attract big, careful players. The paper side is thin enough that those players' actions can move it. And the physical side is tight enough that if a genuine scramble for metals starts, the repricing could leave today's forecast range far behind.